Capital allowances are tax depreciation that tax authority allows against the accounting depreciation, and capital allowances are available on capital expenditure. It will never be allowed by tax authority on revenue expenditure. So first of all, capital expenditure is necessary. Then another thing is that it must be an eligible capital expenditure, that is plant and machinery. So capital allowances are always available on the acquisition and use of plant and machinery, but not available on building, because building is not part of plant and machinery. But if anything is integral feature of building, then it would be considered as plant and machinery. Now, as far as the types of allowance are concerned, the business can get capital allowance in terms of annual investment allowance, which is available on the acquisition of a plant and machinery only. And business can also get the writing down allowance, that is WDA, which is available against the use of the assets per annum. Each year you can get WDA when you use the asset. And a first year allowance, which is only available on the acquisition of a car and a specific type of car. So there are three types of allowance that the business can claim in terms of capital allowance, that is AIA, the WDA, and the FYA. Now, these rates will be provided to you in the exam text sheet, that is how much AIA is available. So as far as rate is concerned, the AIA rate is 100%, and the expenditure limit is 1 million. Previously in FA18, that expenditure limit was only 2,50,000 pounds. So now it has been exceeded by 7,50,000. So expenditure limit is 1 million. So that means if any plant and machinery is being purchased above 1 million, then 1 million is available in terms of AIA. The other rates are the main pool item of plant and machinery would attract 18% written down allowance. So this is the rate of the writing down allowance. And if plant and machinery falls in a special pool item, then the rate is 6% per annum. So 18% and 6% per annum are the rate. Now, as far as car is concerned, motor car is concerned, the new motor car, so we have to see the CO2, that is carbon dioxide emission rate of the car. If it is up to 50 gram per kilometer, then a rate of 100% is available, and that is called first year allowance. And if car's CO2 is between 51 from 51 till 110 gram per kilometer, then there will be a WDA of 18%. And if the car CO2 exceeds 110 gram per kilometer, then there will be a WDA of 6% per annum. Now, let's see how we can use the pro forma or the calculation like. So let's start from a basic example. A business starts, the business accounting period is year ended March. So it starts from 6th April 19, and its accounting period ends at 5th April 2020. This is the normal tax year. So in this tax year, a business purchase a plant and having a cost of 1.5 million. This is the start of the year. Now, how much capital allowance is available? So we have to make some pro forma type. So let's make a pro forma. A column, that is the main pool, and a column, that is allowance. So first of all, we have an addition that qualify for AIA, and that addition is a plant. So the cost of the plant is 1.5 million. How much AIA is available in a given year? That is, the limit is 1 million. So 1 million is immediate allowance, that is AIA, and the excess is to be transferred to the pool. Pool is like every asset is a part of pool. So we will not calculate written down allowance on each isolated assets. rather than the asset will be a part of pool, and on the pool balance we will get the written down allowance. So now uh, after finding this out, let's find out the balance. Now this 500,000 would attract a WDA of 18%. Why 18%? Because the main pool item would attract a WDA of 18%. So 500,000 into 0.18, and that is 90,000 WDA. So that WDA is also part of the allowance column. So in this way, you can see that we have the balance available, that is 4,10,000, the balance available, and this is called TWDV, closing balance, tax written down value, closing balance 4,10,000, which would be the opening balance for the next year. And the total allowance that we have get is 1,10,90,000. So this is total tax depreciation or capital allowance that is available in this period. Now moving forward, for example, now we have a brought forward value. So we can see that tax written down value brought forward is available for a business, that is 2,50,000, suppose. Now there is an addition, and that addition is we have purchased a plant at a cost of 1.2 million, and a motor car having CO2 of 100 gram per kilometer, and the cost of that is 50,000. So capital allowance, we have to find out capital allowance. So in this way, we have two items.